Good evening. Today is the 24th of October 2023, and this time my topic is about investment. Don't think of it as just investment in stock exchange stocks. This is true for all investments. Even if you are like a gold bug collecting gold or silver bug collecting silver, or maybe there's no limitation. You can do them all together at once. Or the shares of commodities, not the companies. This is like oil and petroleum as well, or the commodities like industrial commodities like aluminum, steel, copper, or just government bonds, T bonds, 5% T bonds. What I will say, I'll just give the example from stock exchange. There is a adage saying you must not try to time the market. What's meant by trying to time the market? Like selling something, getting your cash, waiting outside so that it drops so you buy again. This sounds very logical, selling high and buying cheap. But there's also another way when shorting stocks where you can sell first and then buy later when it's down. But these are all complicated for a small investor. And if you're not playing with huge amounts of money, making money from small arbitrage, in the long run, most likely you will lose a lot of money because there are some reasons for losing the money. And this has been continuously checked by agencies, by statistics. Is it a good idea to stay in the market instead of timing the market? Just spend time in the market by adding more. If it drops, that's my let's say logo. I buy more, okay? But it doesn't mean you must catch the falling knife. You should catch the falling knife, but slowly in small amounts. Not that you have a money in the corner. Oh, okay, it fell 6%. Let me buy all of it. That's wrong, because it can go deeper and deeper and deeper. Then you will run out of money if you do that. But if you're just drawing regular salary or trying to save some money, just spread it to a basket of goods and try buying from all of them. Although you can do this, like instead of buying all gold or stocks, based on that day's, let's say, popular investment, you can invest more in gold, but never forget the worst investment, because that's where you are going to make the money. If oil prices are way down to $20, they are going to be $130 one day. If gold is very bad, not increasing, that's what you should be collecting. That's going to be $2,500 in the future. So stocks, if they are already high, with the first 7 stocks leading the Nasdaq, and if you take them out, the stock exchange is at a loss in S&P and Nasdaq. So this shouldn't scare you, because previously it was also similar. Maybe not 7 stocks, but it was 15 stocks leading. Also, another item, like in the market in Turkey, there is 8 million plus investors, let's call small investors, most of them. Only 3% of investors hold 95% of the stock exchange of Turkey. The remaining millions and millions, they only have 2%, okay? So how can you affect the market with just 2% trying to buy this and trying to convince others to buy or sell this? I personally don't invest in stocks. I do invest in stocks, but by professional means. I invest, in fact, all over the world, like in Nasdaq and S&P and almost all stocks, all commodities, all Turkish stock exchanges, gold, silver, industrial commodities. How do I do that? With small amounts of money, or am I very rich? No, you don't have to be rich. You buy mutual funds. What mutual funds are? Like if a mutual fund is named like a gold mutual fund or silver mutual fund or industrial commodity mutual fund, or US stock exchange, or technological stocks, or health stocks. So they can group those stocks together and then put them in a bag, and then you can become a partner of that bag. It's like buying a share in a land, in a building, in a package of goods. The package of goods don't have to remain same. The people who run the package, they can take out the companies that are not performing good. They can add in new companies that are doing good. So if you trust, so what, how can you be sure that these people will be running it better? Well, for sure they can run better than you do, because most of them spent 20 years, 25 years in the stock exchange. At least that's the situation in Turkey, to get their certificates in time. But another thing is, like, these people are every day within the market, so they can see how the profits are coming, so they can change accordingly the shares. If they hear something that this firm is going to go bankrupt, they can just drop it from their list and add a new one. You can't. I mean, you have jobs to do. You have different business. You don't want to be a full-time person watching the TV console from morning to day and night. It's not fun. It's boring. So some people may enjoy it for a short while, making money in the forex like six times, seven times, then losing six times, seven times. But as I said, if it's not a hobby type thing, stay away from those, because every sale you make, every purchase you make, you pay a commission. So it's better not to change the bag continuously, rather than select a person who selects a very good bag of companies, looks at them long term, does not care what happens in the industry. Like, there is a Turkish mutual fund like that. I know the let's say boss, or the running person, he selects like 15, 20 stocks, and maybe changes only one, every year. So he doesn't keep changing. This is doing good. So he's staying invested and spending time in the companies that he had researched. So if they tell you you cannot buy and sell stock, you can just become a partner of a company. So if you are a long-term investor, that's what you care. You don't care what happens daily. So based on that, his strategy is investing that way. It's a MAC coded company run by Haydar Acun. I'm not just trying to advertise him. I'm just telling his idea of investing. On the other hand, there are people who are investing daily, changing according to companies, small size companies. If they're running in the short run, you make more money maybe, and they're at more risk, but you may make more money when it's a bull market. Okay. But when things go bad, they fall down faster than all the others. So it's up to you to choose your mutual fund, not the fund, the people who run it. And so you can check their 2-year, 3-year, 5-year, 10-year career, and that's shown how much that funds are made in the past. Okay. So similarly, you can buy trend mutual funds, like stock exchange indices. Like, you can buy an S&P index, like there is Vanguard, VOO, for example. Then there are how do I say, the ones that you can choose. There are many mutual funds to choose from. Some are paying annual dividends. Okay, so you can choose dividend let's say mutual funds. So they all come within the name. Like I said, commodity mutual funds, gold mutual funds. So ETF is different story, because ETFs you have to buy and sell during the hours. They are also related to some item like gold, silver, petroleum, stock exchange, but that's, I think, another professional area. In Turkey, when you buy mutual funds of Turkish mutual funds, you pay zero taxes on them. Okay, no taxes, no income tax, even if you make millions. It's not like USA. And recently, a friend sent me his studies of how much he made in the stocks in Turkey, and I checked. It's incredibly high. Like in 1 year, 80%, 70% increases in general mutual fund. Not on a single stock. So American can understand this. Turkish people can't, because most people Turkish people can't, because there is very high inflation here. So 60, 70s are not very high numbers per annum. But we are used to 250%, 200%, 1,000% maybe in some cases. But in US dollar terms, many of them made above 50%, which is in states investing long. You make about 10 to 12% if you stay invested, or 7% average is considered very good. And people who try to time the market, they mostly make 2% per year. So if you think of a 50% staying 1 year, it's like spending 25 years of this guy's time. Okay. So now I like to show you some additional information. Don't bother about the date of it. Information inside doesn't change at all. So I will just show that to you on the screen. Okay, now it's on the screen. I can stay as well, so it does not matter. So, okay, now explain. Stop trying to market the market. Do this instead. Okay, so they got a clock as well. It says marketing the time to sell, time to buy, time to sell, and that's smart timing. So this article is November 2022. It's a 6-minute read. So I attached a link to this video if you want to keep the information. So basically, what is market timing? Market timing is opposite of buy and hold strategy. Is buying or selling because you expect specific change in price of stock or value of an index. So it's like continuous buying and selling, okay? Not buying, holding, and adding on top of it. So you can do this even in gold. You can buy gold, make a little profit, sell it, thinking that it's going to come down, rebuy it, and that's never a profitable thing, I tell you, in the long run. You can make money one or twice, but then the grasshopper cannot jump the third time, you get caught. Okay, now numerous research studies by parties about the failures of market timing. Although, if I were these people, I would say time the market. Reason why? Each time you buy and sell, they make commissions. Okay, so a study by Merrill Lynch found that model portfolios over a 30-year period could underperform by nearly half their value through market timing. So if you time the market, go in and out, you lose half of the money you could win in 30 years. Charles Schwab is another manager, portfolio management firm, tells us research shows the cost of waiting for the perfect moment to invest exceeds the benefit of even perfect timing. Even perfect timing. And because timing the market makes it is well about as likely as winning the lottery, the best strategy for most of us mere mortal investors is not to market time at all. A survey by Putnam Investments found that market timers who miss just 10 days in the market, the 10 best days, could lose up to half of the value of their portfolio. So you must stay, according to all these, invested. Don't go get in and get out. Although I tell this is a timing like daily, weekly, or under. But you can time based on not just one investment, but a group of investments, and say, okay, I expect now this next 2 years gold to make a good performance. You can increase the amount of gold in your portfolio, or you can say it's now stocks time. They haven't been performing good, so I'll stay another 2 years and see if I exceed that 10, 20, 30% Americans make. I do this kind of changes in my portfolio. Putnam Investments says their model found that getting in wrong by no more than a month was the difference between $6,800 in returns and $30,000. So it dropped to 1/3 of it, if they didn't get in and get out. Why market timing usually fails? This is a good article, right? There are several reasons. One reason is that very few can consistently predict short-term market movements. They play with the graphs and this and that, but they don't always work. That goes for spotting a decline before it starts, as well as knowing when the market will rebound. The decision to reduce stock exposure, moving these assets into money market investments or cash, not only means anticipating when to exit the market, but choosing when to re-enter the market as well. Selling, and when should I buy? Because if it increases, you say, okay, I should buy. No, tomorrow it will go back low. So that's the problem. So they made this in a financial crisis. Consider this. They made an illustration of different gray areas are the financial crises, and it's from 2001 to 2022. So even the famous cerveza sickness is listed here. So alternatives to market timing, fine. We can find the reading. I'm just giving you the main spot point. If your main concern is having enough cash to live on, then it makes sense to build up enough savings to cover 2 years. I don't think Turkish people can have a savings sometime for 2 years, because in local money, that money will go to 1/5 of its value. So you should keep maybe 2 months at most, or just use your credit cards, if during those 2 months. This is especially applicable to person nearing retirement or already retired. Because they don't have any other income and just depend on monthly salary. That's what they try to mean. If your main concern is getting protection against a major downturn in stock market, then maintaining or modestly boosting your allocation of bonds makes sense. As you know, the foreign finance groups never list gold, as a protection. So they say bonds, But the last year, people in bonds, U.S. bonds, had the heaviest losses, instead of gains. In times of increasing interest rate, they lost huge amounts of money. So if your main concern is missing out on a market rebound, that things will go up, investing a little time by gradually purchasing stocks. This is gradually, means easy, not fast, kademeli, I call in Turkish, in steps, like climbing the stairs, not jumping the stairs, slowly. One day, one couple of funds per day, or couple of grams of gold or silver per day, not buying the whole amount in one day, because as I said, next day prices may come down, and you will, for the long run, this is no problem even if you buy it expensive, but your psychology will not carry this, the loss you make the next day, the next week. So it requires a professional psychology not to bother about it. Like gold has been increasing through the Middle East situation. So now I will go back to my view again. So Middle East situation, gold went up only slightly, 7-8%. Then it's coming down. Everyone's okay. Now that these are all market players, they are portfolio managers. I don't give a damn to what they say. I stay invested. If it falls, That's perfect. That's the time for me to buy. If you believe in your investment, like you say, there is inflation, the prices will go up. That's where Americans are very, how do I say, amateur. They are amateur about inflation. Okay, and we are experts on inflation. We ran companies for 40 years during very high inflation. I took loans at 220% company loans and still made profit because it's not the interest rate that's important. It's the inflation versus interest rate is important. So you can make a lot more money during inflation because of inflation. There will be a heavy growth in the industry. Everybody, instead of deferring their buyings, purchases, like I'll buy a car later, the price don't change anyway. Now, if you say prices of cars are going up like 2% every month, everybody spends faster, takes a loan, spends even more. So today the PMI numbers from the USA came, and they are saying the economy is very resilient. Of course it will be resilient because there is inflation. Inflation didn't go anywhere. So people want to buy as quick as possible still. Okay, they are not as high as Argentina or Turkey, but 5-10% is a huge amount if you think in US dollars. Just in the last 3 years, your $100,000 is now only purchasing power of $80,000. If you spend another 3 years like this, it will be $50,000 worth of. So you must run quick, keep buying and buy. Okay, I'll buy the mutual funds and I'll buy bonds. They are not good enough. They only give you 5%. Inflation, according to government Bureau labor statistics, is like 4%, 3%, 4%. But if you look at the shadow stats, which keeps track of inflation based on the old figures, they say multiply that by 2. That's the real inflation. That's the before they change the basket of inflation items. Okay, so you don't have time to waste on what's the basket, what's inside the inflation basket. You must run for the highest protection possible. So similarly in houses, they say house prices are not coming down as they should be. Why they should? I mean, it's already a house, $400,000. If there was inflation, it lost 20% of its value. So it's very normal that it should be priced $500,000. Well, people don't have the money. They ran out of. That's bull. That's bull. Because people who already had money are much richer now. People who had loans are much richer now if they sell those houses, because they bought their houses with only 2% mortgage loans. Okay, now it's 8%. And if the rates go down to 2% again, let's say in 2 years, 3 years, their house prices will go up to $600,000, because it's a known fact in the US, every 1% reduction of the interest rates in the mortgages create 10% price hikes. So everybody thinks this is not a good time to buy a house because there is 8% mortgage. Well, I tell you, if it goes down to 2, the house prices will increase by 60%. This is also a study made in the USA, okay? So that $400,000 house today will be $600,000 when you are able to get a mortgage rate with 2 or 3%. Which one you like? You want to buy it at 600,000 or you want to buy it at 400,000 and then refinance later on? There is a solution of refinancing when the interest rates drop. But there is no solution when the house is $600,000. That's it. You have to buy it at that price. You cannot buy and sell it goes down. It's impossible. Okay? So similarly, you should think of all values, not just houses, gold, bonds, everything, all investments, cars. You are losing fast and quick. Okay? Your salary is losing. Although you may have had some salary increases, they will always be below, because inflation is a government-induced act. They print money. They deal a lot of loans why do they do that? Because they cannot meet their spending ends, so they have to print and pay off the debt, pay off the wars around the world, everything. So collect taxes they can't, because there is no taxpayer that wants to pay that much tax officially. So they tax them indirectly, which is called inflation tax. Okay, so and that doesn't bother anyone as much as the direct tax. Like if they say we are going to increase the taxes of income by 5% per every let's say level of tax payment, that's going to cause lots of protests and everything, walkouts, everything. But they say, why worry? Just print money. We're going to take their 20% anyway. So the more loan the government gets, the value of the US dollar drops, or any currency. That's good for governments, because they can now tax higher with the new rate, and their old loans are old rate. That's exactly same tactic I'm applying buying houses in Turkey. I am buying with a fixed rate mortgages before high inflations. During high inflation, I just pay the same amount, which is like equivalent of rent in 1 or 2 years, not like the first year in US. But then in the fifth year, almost all my loan, which I took for 10 years, not 30 years and 50 years, melted to zero. I can just pay $2,000 and buy the whole house. It's all mine. So it's so good to invest in inflation. So it's so good to invest in inflationary countries where there seems to be a risk, but you don't have to buy the risk assets. You can buy, houses, get rent, and you can buy them cheap for $50,000, $40,000. You don't have to buy companies. You don't have to worry about, as I said, they are expert on inflation. You should be more scared in US, because people are not expert on inflation. We are expert. Argentinians still voting for the person who runs now they have two runner-ups, and one said, I'm going to convert the money and now we will have dollarized and we'll use US dollars. The other one is the existing finance minister, and he got more votes because people are afraid of change. They say, rather than change, we just go like this. At least we adapted to this, Okay, everybody is poor. Half of it is on the street, collecting garbage, but I'm not. So even garbage collector is happy. She thinks, oh, at least every day I find garbage enough to live on it, So change is the most difficult thing for people to accept. They rather want to stay same. So for a politician, it may sound good. Change is coming. Everybody will applaud, but on the other way say, I wonder how it's going to hurt my own situation. He's already in a bad situation, but he thinks he's well off, comparatively, because there's always a worse situation somewhere around the world. So, okay, I hope this was helpful reading. And I also took a writing from ChatGPT. What are the buy and hold strategy advantages? I attached it to this video explanation section, because it also mentions about reduced transaction costs. Yeah, as you don't have to pay brokerage fees and taxes, emotional discipline, maybe you panic, and so you cannot panic in a buy and hold strategy. So these are all in the explanation section of this video. I hope you all buy and hold tight from the horns, don't leave the bull. Doesn't matter what you invest in. Just hold tight, okay? Ride the waves with it. If it falls down, better. Keep adding more, okay? If you trust that investment, you should trust it for 10 years, 5 years, not for 1 week, okay? And unless you are a trader, you want to make money from trading, I don't advise to amateurs, okay? Even biggest professional traders only make 1%, 2% from their tradings. They lose a lot, and they start every day from zero. But if he makes 1 or 2% of his buy and sell are correct, that's good enough for him to stay as a professional. You don't run that much money, You have only your money. Okay. Best regards and best night to all of you.